Hello and welcome to the FinTech Magazine Show, brought to you by FinTech Magazine, InsurTech Magazine and BizClick. I'm Alex Clere, and as always, over the next 30 minutes or so, we'll be bringing you all the latest news, analysis and opinions from the worlds of FinTech and InsurTech right here on LinkedIn, YouTube and our other digital platforms. I'm joined today by FinTech and InsurTech editor Lewis Thompson. Lewis, welcome to the show.
Hi Alex, and hi viewers. Great to be back for my second FinTech Magazine Show now. Very much looking forward to it.
Okay, great to have you. As always, don't forget to join in with the chat. Say hello in the comments section on LinkedIn, and even better, tell us where you're joining from today. We may even read a selection of those comments later in the program. For now, let's kick off with the latest news. Okay, and our FinTech news story this month, unfortunately, is rather predictable. Following earlier banking collapses, including Silicon Valley Bank and Signature Bank, we now have the third major US banking failure in the space of 2 months. First Republic Bank has been saved in a rescue package by JP Morgan Chase, who will take over a substantial majority of First Republic's assets. In order to fuel its rapid growth to date, First Republic had focused on offering preferential interest rates to wealthy clients. This led to a loan book at the time of JP Morgan Chase's takeover that was nearly double the amount held in deposits. Last week, the bank said it had experienced unprecedented deposit outflows in the first quarter, amounting to $72 billion, despite receiving $30 billion in deposits from several large US banks led by JP Morgan Chase. That was an attempt to quell concerns about First Republic's future. The extent of its diminished deposits led to fears about a run on the bank, and that has now culminated in this week's rescue deal. Now, one of the broader talking points from these last few months, aside of course from the stability of the global banking system, is whether or not desperate times lead regulators into accepting uncompetitive bids. Obviously, deals like these protect account holders' deposits, which is a good thing, but do they concentrate power in too few hands and undervalue struggling institutions? For example, when Silicon Valley Bank became insolvent, the UK government worked incredibly quickly to secure a private sector buyout. HSBC paid the symbolic amount of £1 to take over SVB's UK operations and protect deposit holders. By contrast, in the US, First Citizens Bank purchased around $72 billion of SVB's deposits and loans at a discount of $16.5 billion, leaving about $90 billion in the continued receivership of the FDIC. Now, HSBC has announced this week that the takeover of SVB's assets has provided a provisional gain worth $1.5 billion in its first quarter results. And even though it hasn't been made public how much JP Morgan Chase are paying to acquire First Republic's assets, it has said that it expects to see a one-time upfront gain of $2.6 billion, partially offset by an expected $2 billion worth of restructuring costs, as well as more than $500 million in incremental net income every year. So, as the global banking struggles continue, this is where our LinkedIn poll for today's show comes in. Lewis, can you tell us what it is, please?
I can indeed, Alex. So our poll for this month is: following the rescue deal for First Republic Bank, are the worst of the US banking troubles behind us? You can answer option A, yes, it's time to rebuild trust. B, no, there's more turmoil still to come. Or C, who knows?
Okay, thank you. Do get voting in that poll if you haven't already done so, and we'll read the results of that later in the program. For now, let's continue with the latest news. And Lewis, what have you got for us on the InsurTech front?
Thanks, Alex. Well, the story I'd like to focus on today does really follow on from the increased volatility we're seeing in the global banking markets, with the fall of firstly Silicon Valley Bank, and now, as you've just told us, with First Republic Bank being rescued by JP Morgan Chase. According to Inbroker, which offers business insurance expertise, business startups and other small and medium-sized businesses have reacted quite badly to the unstable banking climate, expressing concern for the security of their assets by looking for stronger insurance protection. So according to Embroker's data, around 15% of venture capital-backed startups looked at either doubling or tripling their directors and officers' insurance the week after Silicon Valley Bank's collapse. And this was up 7% on the week before the bank's failure. For those who don't know, directors and officers insurance, or D&O as it's referred to, is essentially insurance coverage intended to protect individuals from personal losses if they're sued as a result of being a director or an officer of a business. Searches alone for D&O insurance quotes went up by 62%, suggesting that startups could be fearing a potential recession, forced redundancies, and bank closures. In fact, the quantity of D&O searches sparked a downturn in the performance of $1 million value quotes, the value dropping some 37% from the week after Silicon Valley Bank's collapse. Around the same time, the value of employment practices and liability quotes were also down 25%. Now, at the time of Embroker's report, a similar time was when key international figures came out in defense of the banking market's strength. This included German Chancellor Olaf Scholz, who backed Europe's banking infrastructure at an EU summit, saying union member banks remain stable. But it's worth noting that these comments came after the near collapse of Switzerland's Credit Suisse, which, although outside of the EU, did mark further fragility in the global banking sphere. But despite the attempts of leaders like Scholz to ease any fears for the global banking market, it seems this has done little so far to offer security for startup owners who, according to Embroker's Chief Revenue Officer, Ben Jennings, are characterized by their risk-taking tendencies. We've actually got a quote here from Jennings. He said, "Founders are feeling the pressure. Not only are they worried about capital insecurity, but they also have to consider how the decisions and actions of others can impact their business in the blink of an eye." So with Jennings' words in mind, it's important to note that while the global banking landscape looks stable for now, should more banks fail, as in the latest case of First Republic Bank, it may be hard for small businesses to maintain confidence in the banking economy in the long run. Back over to you, Alex.
Okay, thank you. Now, after the break, we'll be talking with Capgemini about the sustainability progress being made by insurance organizations. We'll also preview the May issues of FinTech Magazine and InsurTech Magazine, which are fresh off the newsstand, and we'll be recapping our fully virtual event, FinTech Live New York, which took place earlier this week. All of that still to come.
The one key takeaway about Fiserv is that we move money and information in a way that moves the world. My name is Sunil Sachdev. I'm the head of FinTech and Growth here at Fiserv.
Matt Wilcox, president of our digital payments group at Fiserv. Fiserv is a global FinTech company servicing banks, credit unions, merchants, and billers, payments, credit, debit, non-card payments, as well as merchant experiences across the globe.
I think we will see continued excitement and expansion of embedded finance. We will see an opportunity to bring our financial institution customers closer to our merchant partners who are looking to embed financial services into their customer experiences. So for us, it's about ensuring that across the broad ecosystem that we serve, we're able to be somewhat of a matchmaker between the businesses that we support from a payments perspective and the banks that we support from a core banking perspective, to work in harmony and to deliver services and capabilities that complement each other.
Hello, welcome back. Thank you for joining us. We do have a really international cross-section of viewers today. So hello to Zinsu from Benin, to Shivani in India, to Ali in Iraq, to Biju in India as well, and to Femi in Lagos. Thank you very much indeed for joining us. For our interview this week, we spoke to Shane Cassidy, Executive Vice President within Capgemini's Insurance Business Unit. Now, with everything going on in the world, we wanted to know how prepared insurers are for the current economic headwinds. Are they letting their foot off the gas when it comes to topics like sustainability and diversity, or are they doubling down? We asked Shane these questions and more when we caught up with him recently. Let's take a look. you mentioned that insurers probably understand that they still need to invest in innovation and in continuing to transform their businesses. And I suppose the point that I wanted to put to you was that perhaps it's a little bit of a double-edged sword. Perhaps some organizations are inclined to hunker down a little bit because of the economic circumstances, maybe to not deviate too much from strategies that they know are working. But actually innovation is, it's more important now than ever, possibly.
Yeah, there's fewer who are dead set on hunkering down and just weathering the challenges of the day and just purely cost cutting than I've seen historically, because this isn't the first time I've been through one of these tough years. It might be one of the toughest years, which I thought would have created far more of that strategy, hunker down. I think we're seeing a lot of people still going forward with move to cloud with a hope to get out of their data centers and reduce costs that way. And I just think that the leadership of insurers today in the board is far more tech savvy than they were 10 years ago. And therefore, they look at technology as, truly being core. Whereas 10 years ago, the underwriter was the end all be all of the business. And they still are extremely important, but there's a lot of people you'll see that have technology backgrounds now leading these programs or in the board that are advising that if they don't modernize, they will not be able to compete in the future. So it's a bit of a different structure at the top, I think, which is helping to somewhat remain consistent towards that drive to modernize and elevate and simplify really the technology stacks.
Okay, so moving on from innovation, what do you make of sort of insurers and their commitment to sustainability, particularly their commitment to addressing their own carbon footprint? Do you think that the economy will affect their commitment to their sustainability initiatives?
Yes, I do actually. In the short run, I think what we're seeing is sustainability as a standalone strategy is one of the early cuts to the transformation agenda. I think sustainability as it relates to where it's embedded in other programs, so a move to cloud or simplification or modernization, sustainability is a lever, but it's not necessarily the primary focus of that transformation initiative, where you would have seen more, things that were primary towards that space. So I think it is going to take a bit of a hit. However, you will see sustainability linked to a lot of other things, so to ensure that from a brand perspective, they're still getting out there that they're addressing sustainability. But I do think it's going to probably have a little less focus than it would have had otherwise. Okay, thank you. Is there anything you think that governments should be doing right now to incentivize insurers to spend in areas like sustainability, innovation? Well, I think you've seen a kind of a dichotomy or a differentiation between multiple different countries who have different programs in place or incentives or regulations for that matter that are driving different behaviors, and they absolutely have an impact. I think any country that decides that they want this, then you almost have to create regulatory requirements to enforce it if you want consistency or a unified approach or even unified outcomes. I think what you have right now is brand-wise, people are pressured to do the right things because it has an impact on how they are seen in the marketplace by a lot of, especially the younger customers, and therefore they're driving it on their own. I'm a free market principles kind of guy, so I'd prefer that the business is driven by the outcomes and the market as opposed to the regulations. But I think it's probably inevitable that you'll see more regulatory requirements to drive maybe faster adoption and or more focus around as it relates to sustainability over the next several years for sure.
We thank Shane very much for his thoughts there. Now it's the start of the month, and of course with that comes the launch of a new FinTech magazine, which you can now find live on the FinTech Magazine website. In our May issue, we look at the future of banking in the metaverse, what payments could end up looking like with the future of cash uncertain, and the possibility of NFTs becoming gaming's biggest revenue generator. We also delve into the role that emerging markets will have in reshaping the future of the global financial economy, and readers will have the chance to look at the latest updates from industry-leading companies, the likes of Rabobank, IBM, Fiserv, NMI, Qualco, Generali, and Mambu all included. For access to May 2023's FinTech Magazine, just head to fintechmagazine.com/magazines. Now back over to Alex, who's going to run through the recent launch of our InsurTech digital magazine for May 2023. Alex.
Yeah, quite right. So not just one new magazine for you this month, but two new issues with the launch of InsurTech Digital for May. In this issue, we explore one of the most important assets that insurers have available to them, data, and ask how better they can use data to improve the experience provided to customers. We also delve into fraud prevention and examine what companies can do to mitigate against the rising tide of insurance fraud. Our top 10 is all about sustainable insurtechs, and you can hear from leading voices at Zurich, Generali Vitality, Cover Genius, and Cognizant. So please do go and take a look at that. The latest issue is available to read at insurtechdigital.com/magazines. Okay, now we do these live shows every month on LinkedIn, as you know, but we also have a series of live events too. Our latest virtual event, FinTech Live New York, took place on Wednesday. Now, if you weren't there for it, here's a quick recap of what you missed.
Join the virtual event disrupting FinTech and InsurTech at FinTech Live New York. Join me, Neil Perry, and over 20 expert speakers, where we'll be discussing themes from digital banking to paytech, digital currency to financial technology, sustainable finance, and of course, insurance. See you on the 3rd of May.
It really was a great event, and I can say that with confidence because I hosted the InsurTech stage, where we had lots of excellent speakers and some lively discussions about the future of insurance. My colleague Neil Perry there also hosted the main FinTech stage. Now, if you weren't able to attend, but you registered for the event, you'll be able to catch up with content on demand using Brella. If you didn't manage to sign up before the event, that's okay. We'll be releasing select sessions from FinTech Live New York on our FinTech Magazine YouTube channel over the next couple of weeks. We also have a hybrid conference called FinTech Live London that returns this year from the 8th to the 9th of November. And of course, FinTech Magazine will be out in force at Money 2020 Europe in Amsterdam from the 6th to the 8th of June. Speaking of big events, congratulations to friends of the show, Stephen and Gabino Roche. Their FinTech, Sapphire, was named FinTech of the Year by Global Custodian this week. We have an interview with them about their achievement, conducted by BizClick's Chief Content Officer, Scott Birch, coming up soon on our digital channels. Okay, I think it's just about time to catch up with our LinkedIn poll. Lewis, can you remind us of the question and give us those all-important results, please?
I can indeed, Alex. So to remind viewers of the question, it was following the rescue deal for First Republic Bank, are the worst of the US banking troubles behind us? Option A was yes, time to rebuild trust. That got 16% of the vote. Option B, no, turmoil still to come. That got the majority there with 61% of you voting for that. And C, who knows, got 23% of the vote. So it looks like most of you are thinking more trouble ahead for US banking.
Okay, yeah, a little bit of pessimism possibly there, but that's understandable given the circumstances. Thank you, Lewis, and thank you to everybody who took part in that poll as well. If you didn't already, you can still have your say by visiting our FinTech Magazine LinkedIn page. We'll leave that one open for a few days still to come. We're almost at the end of this week's show, unfortunately, but we do still have time for one last thing. Our traditional end of the show is back. And Lewis, this is the first time for you taking part of one of these, so you have absolutely no idea what to expect, do you?
I have no idea, Alex, and this is the one thing I've been dreading for the show today because I've got absolutely no idea what to expect. So I'll let you take it away, shall I?
Okay, well, hopefully it won't be too much of a nasty surprise. So given that we've spoken so far about businesses and their commitment to sustainability, we thought that we'd look at the biggest sources of carbon emissions. So this isn't specifically for FinTech and InsurTech, this is for all businesses, and the data is courtesy of the US Environmental Protection Agency. So the name of the game, Lewis, is for you and our audience to guess the biggest source of greenhouse gas emissions as we take on Play Your Environmental Cards Right. Oh yes, we're back. So the first category is agriculture. Agriculture makes up 10% of all greenhouse gas emissions according to the EPA. Okay, our next category is industry. So that involves all of the energy and the chemical reactions needed to produce goods in factories. Lewis, do you think that industry is higher or lower than 10% of US greenhouse gas emissions?
I'm going to say, Alex, that it's lower than 10%.
Lower than 10%? Well, let's take a look. It's actually higher at 23%. So industry accounts for 23% of all greenhouse gas emissions in the US. That's obviously much higher than agriculture. So the next category is commercial and residential. So that's everything needed to run domestic appliances in the home and the workplace, including heating, lighting, refrigeration, cooling. Do you think all of those emissions are higher or lower than 23%?
Oh, well, there's more houses, flats. This is all in the US, right, Alex?
It's all in the US, yep.
US. Oh, industry. I'll go higher this time because lower didn't work for me last time, did it?
Well, lower didn't work for you last time, okay? But unfortunately, I don't think higher is going to work for you this time either because it's 13%. Yes, commercial and residential domestic appliances produce around 13% of US greenhouse gas emissions. Okay, so moving on, we have electric power. So this one is fairly self-explanatory. It's all the emissions that come from the generation of electricity. Obviously, this is highly dependent on which country you're in and what clean energy mix you have. But for the US, do you think electricity generation is higher or lower than 13%?
I've got to get one right. I'm going to go higher.
You're going higher, and I think you have got one right because it should be 25%. Yes, it's much higher at 25%, a quarter of the mix. So generating electricity produces a quarter of the US's greenhouse gas emissions, although land and forestry offsets about 12% of all emissions in total. So finally, we have transportation, cars, trucks, ships, trains, planes, that sort of thing. So if you've been doing the maths so far, Lewis, as you go along, you'll know exactly what percentage transportation adds up to. But is it higher or lower than 25%?
I have not been doing the maths at all, but just going off transportation as I know it, I would just say higher.
You think it's probably there's a lot of moving going on in America, so there's probably a lot of emissions. Okay, so let's take a look. It is indeed higher at 28%. So transportation amounts to the biggest producer of greenhouse gas emissions according to the EPA. So well done, you survived. That was Play Your Environmental Cards Right. Unfortunately, that's all for this month's FinTech Magazine Show, though. We'll be back on Friday, the 2nd of June, so please do put that one in your calendar. If you've missed any of this week's live If you've missed any of this week's live virtual event, FinTech Live New York, you can catch up on demand now. We'll also be posting select highlights onto our FinTech Magazine YouTube page. Thank you so much to Lewis. Great to have you on board again. Thank you to our production team for putting on a fantastic show, both today and on Wednesday. Thank you also to Shane Cassidy, EVP Insurance for Capgemini, who joined us earlier in the program to talk about sustainability. The full version of that interview will be available to read on InsurTech Digital's website very soon. And thank you to you for watching and taking part. Have a fantastic weekend, whatever you're up to. And until next time, goodbye.